Welcome to our first grade 12 session. My name is Sxolile Radebe, and I'll be the one who's going to be assisting you with accounting for the rest of the year. As we've spoken on the group, we are going to talk about companies today. It's going to be an introduction to companies. If we get time, we're also going to get to discuss the ledger accounts with regards to companies. So for us to start with everything, I think that it's going to be very important for us to really understand the background and answer certain questions with regards to the topic. As a background, remember that in grade 10, so your accounting journey so far, so as a background, in grade 10, you studied or you were focused on a business structure called a sole trader. And then in grade 11, you focused on a business called a partnership. This was your grade 11. So this means that at each and every level of your accounting journey, you are going to be expected to prepare financial statements of different types of business structures. So in grade 10, you were focused on a sole trader, and the sole trader was a business that was owned by one person, meaning that the person is the one who is the owner and also the management of the business, which means that he's also the one who's running the business. And with this type of business structure, most of the time they're informal, but all the profits, they also belong to the owner. And for the mere fact that the business is informal, they don't pay what is called company tax, which is a concept that is going to be introduced to you here in grade 12. And then in grade 11, you focused on a business structure called a partnership. So a partnership is when now two or more people, they come together. I think it's 2 up until 20, if I'm not mistaken. So they come together, they contribute the resources to the partnership, then they start the partnership. This one also operates more like a sole trader as well, but the difference is that it has many people that are involved. It has many partners, or it has many owners that are involved. You can set up a partnership by drawing a partnership agreement, so that whatever that the partners agree on, at least it's written down on paper. So this is your grade 11 accounting. All the profits of the partnership, they belong to the partners. So if the profits of the partnership belong to the partners at the end of the year, it means that the profits have to be shared amongst the partners. That's why you did an account called an appropriation account, whereby the partners at the end of the year, we were sharing profits amongst the partners. If there's a partner who got a bonus, if there's a partner who earned a salary from the partnership, we shared the profits that were generated by the partnership. So this is what you did in grade 10 and in grade 11. However, in matric, we are going to focus on a different type of a structure, and the business structure is a company. So a company is very different from these two business structures that I've spoken about already. So what is a company basically? A company is a business structure that has the owners, that are different from the people who are running the company. And so in a company, you have the people who own the company, those are called shareholders. Those are people who have invested money into the company. And then there's people who are employed by the company to run the company on behalf of the owners. Those people, it's directors, it's the management of the company, the employees that are involved in the company. So it's a different type of a structure that you are working with now. The company is a legal entity on its own, so it means that it's a person according to law. The law regards the company as a person, so it's a person on its own. So a company has its rights, a company has responsibilities as well as a company. So, and because now there's a separation between the owners and the people who run the company, there's a lot of things, or there's a lot of loopholes that you can speak about, that you can recognize from this type of a structure. For an example, if the owners are different from the people who are running the company, what if the people who are running the company are not performing in the best interest of the owners? Maybe that's a question that you ask yourself. However, there are policies, there are laws that the people who are running the company have to abide by, so that they represent the interests of those who have invested money into the company. So how does one start a company? For you to start a company in South Africa, you have to go to an institution called the CIPC. That's where you record a company. That's where you register, a company. And then when you register a company, there's a document that you must prepare. It's called a memorandum of incorporation. So a memorandum of incorporation is like the constitution of the company. So it's a document that labels things such as the rights, the duties, and the responsibilities of the shareholders, the directors, and others who deal with the company. And then when you start a company, this is the document that you've got to prepare. And then now, how do we get to a point whereby the owners of the company are separate from the management of the company? The companies that we are going to deal with, specifically in grade 12, is companies called listed companies. So these are the companies that are listed on the financial markets. So here in South Africa, we have the Johannesburg Securities Exchange, of which is where companies can sell their shares. So what does it mean when they say the company is selling their shares? So when a company wants to raise capital, so when the company wants money to raise money, maybe that they can use for expansion and all those things, they go to the financial markets, of which is the Johannesburg Securities Exchange, and then that's where they can sell their shares. And when they sell these shares, they give you a certificate. That certificate is just a certificate showing that Mr. X is owning maybe 50,000 shares in company Y, for an example. And so by being a shareholder, or by being someone who's the owner of the company, it means that when you are entitled to something called dividends. So our dividends, it is when the company gives out some of the profits that were made during the year. So it gives those profits to those people who have invested. Who are these people who have invested into the company? It's the shareholders. So shares are sold at a financial market, and here in South Africa, that financial market is called Johannesburg Securities Exchange. That's where they sell securities. Security is the shares that are sold by the company. And so we have spoken about shareholders to say those people are the owners of the company. We have spoken about the directors to say those people, the directors and management, to say those people are the ones who are responsible for running the company on behalf of the shareholders. So there's going to be something called an authorized share capital. So in authorized share capital, let's write it down. Authorized share capital. So an authorized share capital, these the shares that the company is allowed to issue according to the memorandum of incorporation. Remember, a memorandum of incorporation is like a founding document of the company. It speaks about the rights, the responsibilities, the duties of the shareholders, the directors, and others who are interested in the company as well. And so an authorized share capital is the maximum number of shares that the company is allowed to issue as per their memorandum of incorporation. Of course, this number can change. The company can change the authorized share capital from time to time, especially if they want to expand. And then there's also something called issued share capital. Issued share capital. So issued, the definition is in the name, guys. Issued share capital. So issued share capital, this is now the shares that are actually issued. So these are the shares that are actually issued to the public. These are the shares that are actually issued to the public. So these are the shares actually issued to the public. So these shares are bought by shareholders, for example. So you'll find the question is going to tell you that maybe, for an example, the authorized share capital of the business, maybe they will tell you that maybe it's 100 shares, but the shares that are issued is how much? Maybe it's 50, for an example. So it means that there's outstanding shares I-50 that are not yet issued, because the ones that the company is authorized to issue is 100, but the ones that they've actually issued is only 50. So there's another 50 that they can still issue when they want to raise capital in future. If you want to ask Witty, what if now the company reaches the issued shares of the company, they reach the number of authorized shares? What happens? The company can simply increase the authorized share capital or the authorized shares, so that they can raise more money if they want. So yeah, that's that. So we've spoken about the authorized share capital, which is the maximum number of shares that the company is allowed to issue. We have spoken about the issued share capital, which is the shares that are issued now, the shares that are actually issued to the public. So when shares are issued to the public, they're advertised through a document called a prospectus. So a prospectus is just like a flyer that advertises the company, to see it speaks about the vision of the company, the mission of the company, their strategy, their objectives, what they want to achieve, and all those things. It's just like a prospectus. It's a prospectus, actually, just like university prospectus, that tells you more about the company that you are interested in. And then we spoke about listed public companies as well, to see listed companies are companies that sell their shares on a platform called the Johannesburg Stock Exchange in South Africa. So they are able to sell their shares to the public. So me and you can buy those shares at any time whenever we want to buy them. So they are able to issue those shares to the public. So if even right now, if you want to buy shares from MTN, they are there. They are there. You can just create an account with a broker called Easy Equities, and then just buy shares there, and then be an owner of MTN South Africa. We have also spoken about shareholders as well. To say shareholders are the owners of the company. These are the people that the Companies Act is going to, like, it protects actually, because these are the people who have invested their money to the business. So they are protected in terms of the Companies Act. For an example, maybe when the business is about to close, for an example, these are some of the people that have to be prioritized in terms of being paid back their monies, because they've invested in the company. So if, for an example, you want to visualize now the structure of the company, so the structure of the company, you are first going to have so the structure. So you are first going to have what is called the board of directors. So these are the people who are so these are the people who are elected and re-elected by the investors, which are the shareholders. So the shareholders, they elect a board. So they elect a board of directors. And then in turn, this board of directors, what do? They appoint now. They appoint different types of committees now. You'll find that there's what is called, for an example, an audit committee. We are still going to elaborate and all those things. But an audit committee is responsible for making sure now that the financial statements of the business they're in line with the laws, to make sure that the financial statements of the business, they faithfully represent everything that happened in the business within that specific type of financial year. The audit committee is also responsible for things such as internal controls of the company and etc. The board of directors also appoints what is called a CO. So a CO is the chief executive officer. Is the chief executive officer of the company. So this is the person now who's the head of the company in terms of running it. And then from there, they also have other committees as well, such as, for an example, the social and ethics committee, the remuneration committee, and all those things. And then from there, from this level now, it's the next level. This is the management. The next level is the management. So the board of directors is going to employ the management of the company. So these are the people such as, maybe for an example, the production manager, the marketing manager, a finance business partner. So these are the people who are involved now in the running of the operations of the company, for an example. The board of directors is responsible for the direction, like the overall direction of the company in terms of the strategy, the vision, the mission of the company, and where they want to take the company in the future. So, as you can see, that the shareholders are not necessarily involved. The shareholders are not necessarily involved, and they just invest their money in the company. They are the ones who are the owners of the company. And then the board of directors, it acts on behalf of the owners of the company, which are the shareholders. Okay, we have spoken about the shareholders, we have spoken about the directors, we have spoken about the issued share capital, we've spoken about listed public companies, we've spoken about the memorandum of incorporation. Now, what is an issue price? What is an issue price? So an issue price is just the price at which the shares now are issued to the public. So they will tell you that, for an example, so they'll tell you that company Y issued 100 shares and at maybe 5 rand each. So this is the issue price. So this is the issue price. This is the price per share. So for you to get the issued share capital, what do? You take your issue price. Then you multiply it by the number of shares issued. The number of shares issued. So for an example here, the issue price is 5 rand, and then you multiply it by 100. So the issued share capital now is how much? 5 times 100 is 500. So the issued share capital, let's do this. So the issued share capital will be equals to 500, for an example. So this is what we are going to record as equity that was raised from the public. Okay, let's continue. I'm just trying to make sure that I've covered everything, guys, because I want us, when we start doing the examples, I want us to be on the same page, and I want us to speak about things that I've already explained. See, okay. Now, I've spoken, or I've introduced now to you what is a company. We've spoken about the different things or the different concepts that are involved in a company. We've spoken about the directors, the shareholders, and all those things. Now, there's something unique about the company that is not there actually with regards to a sole trader and the partnership that you didn't learn about last year. And I'm going to try to introduce to you in this video, but even in future we are going to speak about it. So there's something called an independent auditor or independent auditors, or sometimes they are called external auditors. And then when you go up within the accounting field, they will tell you that those are public accountants. So what does this mean? So here's the scenario. When there's a company and the company prepares its own financial statements. So what does that line mean? It really means, for an example, it's like you. Akiri, you are going to school right now. You are a student. You are a learner. And if when you were preparing your own report, or if you are responsible for your own report in terms of writing down your own marks on the report, and we both agree that you are never going to write marks that you got for your exams or for your tests. So for an example, if you got lower marks on a certain test, you're going to misrepresent those marks. You're going to inflate those marks because you don't want to fail again, and you have the power to you have the power to influence now the marks that are going to appear on your final report. So you are not going to give yourself lower marks. So this is the thing with the company as well, is that it prepares its own financial statements, and then when it prepares its own financial statements, they are going to want to represent themselves good. For an example, they are going to there's a risk that they might not produce information that is a true reflection of what happened in the company. So, for an example, there's a risk that they might maybe inflate their assets on the balance sheet. There's a risk that they might inflate their profit on the income statement, for an example. So, to solve that problem and to increase like the trust of the public and the auditor and the shareholders, there's companies called external auditors. So if you've heard about the company like PwC, BDO, Deloitte, KPMG, those are the companies that now they go through, they check the financial statements that have been prepared by who? By the business. And they check the financial statements that have been prepared by the business to make sure that they are a true reflection. They are a true reflection of the operations of the business and everything that happened. Just like you, if you are responsible for your own report or for preparing your own report, there needs to be someone who's going to oversee, or there needs to be someone who's going to monitor, to ensure that the marks that you're putting there on your report, those marks are a true representation of the marks that you got from the tests and assessments that you were writing during the year. So this is how you think about this thing. So the external auditors now, they are responsible for that. External auditors, the people who are auditors, they belong to certain accounting bodies. For an example, there's a body called SAICA, which is the South African Institute of Chartered Accountants. There's a body called IRBA, which is the Auditors Regulatory Board of South Africa. So those are organizations that are responsible now for ensuring now that the financial statements that the companies prepare, they are a true reflection of the operations of the company. And I hope you understand, guys. And then as time goes, we are going to speak about the different types of audit reports. And just to browse over them, it's the unqualified report, the qualified report, and the disclaimer. And we are still going to talk about them and explain them in detail and see them with some examples as well. And then the next thing that I want to talk about, the next thing that we are going to talk about is the share capital of the business. The next thing that we are going to talk about I think on the next session, because I don't like it when my sessions are too long. It's very difficult to focus for a very long time. On the next session that we are going to have on Thursday, we are going to speak about, we are going to introduce company ledgers to you guys in terms of how do we do a ledger account of a company, how do we do bookkeeping of a company. And for now, we are going to stop here for today, guys. So thank you very much. If you have any questions, please feel free to ask them. Otherwise, we'll share more information on the group, guys. For those who maybe want to suggest things, or for those who want to ask certain questions as well. But on Thursday, just to remind you, we are going to speak about how to do bookkeeping for our companies, guys. So anything other than that, today we are done. And please go back to your notes and make sure that you understand all the concepts that you spoke about, because once we start doing like the actual accounting, the bookkeeping, we are going to move very fast, guys. And I'm going to need the people who are going to be able to work with me.